President Schmid, thank you so much for joining me here in Jackson Hole. It's great to have you on Yahoo Finance.
Yeah, welcome. 48th year of this conference. It's pretty amazing.
Yeah, you are set to kick off your annual economic symposium this evening. This is your second year at the helm.
Yes.
And the theme of this year is labor markets in transition, demographics, productivity, and macroeconomic policy. We know that there are changes in immigration and immigration policy, I should say, that are impacting the labor market and the supply of labor. At the same time, AI is here. Mm-hmm. How are you thinking about the theme this year and the longer-term trajectory of the job market, given policy changes and longer-term dynamics at play?
Yeah, I tell you what, we design these things 8 or 9 months ahead of time, and you hope that the subject matter, because it's very researched, there'll be 4 major papers launched at this symposium. It's a subject, frankly, that I've been really interested in for a long time, and it's not just national labor force dynamics, but it's global. And so I think you're going to see emerging from this conference really a better understanding of how the labor force is growing, shrinking. You'll see subject matter like fertility rates, migration patterns inside the U.S. Certainly things like immigration policy affect labor force. And then, as you brought up, AI. I mean, I think there's a natural thing going on with, I'm a baby boomer. As baby boomers retire out, how are we going to kind of fill back? Because we're not having children at the rate we used to have, 50 years ago. So I think the timing and the convergence of all of these things are going to be, I think, quite important, not just for the American economy, but for international economies.
Turning to the more near-term outlook for the job market, the government jobs report for the month of July showed a weaker payroll number. You said in a speech on August 12th, you think that the labor market is still healthy, it's still balanced. If we were to get another weaker reading on payrolls for the month of August and/or downward revisions to July, June, sort of forcing down the 3-month average into negative territory, would that concern you? How would you look at that?
So we have a very important dual mandate, as you know. We've got the stable prices and full employment. By most measures, we're in a really good range on full employment at about 4.2% unemployment rate. What we found is because a lot of, you've got data that come from 2 large sources. One is just the natural data that you're going to get from lots of independent and government agencies. The other data is maybe as important to me is getting around the district to the 7 states we cover in the 10th district and just sitting down around tables with leaders, business people, communities, and finding out what is the inside baseball to what's happening in both the labor force and your businesses. What I believe happened in the first couple quarters was because of all the change, there was large legislation happening, there was new immigration policy, that there was definitely probably a cooling to the hiring rate. But I think as we hear from businesses, that uncertainty maybe gave them a pause. But what is interesting in just the last couple of weeks on a real-time basis, we're seeing a different type of mentality. There's an optimism about the last couple quarters of the year. People seem to be stocked with inventory, and I think the data coming between now and the September meeting is going to be very consequential. So if we do see patterns and risk to the labor market itself, I think we'll start to consider and weigh the inflation data to the labor data, and we tend to kind of go back and forth relative to that. There's very healthy friction between those 2 mandates, and so we'll figure it out, I think, and I think September will be important.
If we did see negative job growth, how would you react to that?
So I think it'll be in the context of what else are we seeing. So I have a belief that we still have a long mile yet to get inflation toward the 2%. I think there's a lot of data for me that would say that we're leaning more toward a 3% inflation rate versus 2%. And I think the cost to the American people is pretty consequential, that last percent, that last mile, so to speak. So it will depend on where we see the balancing of that inflation data to the labor data.
And to your point, you said in a speech on August 12th, quote, "While increased tariffs seem to be having a limited effect on inflation, I view this as a rationale for keeping policy on hold rather than an opportunity to ease the stance of policy." And you warned in that speech that cutting rates could reignite demand in the economy and incentivize firms for greater pricing power. So are you less concerned about the impact of tariffs on inflation and more concerned about underlying demand? And how are you looking at the fact that services inflation popped up in July? How is that all tying together for you on the inflation front?
Yeah, I think that's exactly right. I think watching that demand data is really going to be important as we go into the third, fourth quarter. I think the nature of that demand feature and what it is doing to the price levels of goods and services, I think there is some interesting service data. The PPI was a little bit eye-opening, but the nature of that's going to resolve itself in some of the prints that come out here in the next few weeks.
To your point then, in terms of wholesale prices, we saw that really pop up for July, and that was driven by the services side. Does it concern you that perhaps businesses may pass that on to consumers in the coming months? Could consumers see higher prices in the coming months?
I think there's a risk of that. I really do. The nature of where that's coming from will be interesting to look at relative to the labor force movement. But I think there's a chance relative to some of the more recent prints, even some of the discussions we're having with businesses in the 10th district, that there is maybe a little bit of a lean toward that they have some agility to raise prices in the third and fourth quarter. So we'll see how that comes out.
So taking together your outlook for the labor market and your outlook for inflation, do you think that the case has been made, given the data we've gotten since July, for a rate cut in September?
So I think we'll see. I think our policy stance right now is, I would call it modestly restrictive. I'm still trying to figure out where some of the restriction is manifesting itself. It seems to me like we made a really good effort to get the highest inflation numbers down into the middle high twos, and trying to get that number closer to 2, I think, is important. I think it's important. It's our job to do it. Now here again, if we see friction of inflation that is creating fewer jobs in the market, then you've got another interesting conversation that, you start to talk about these stagflation
and what
elements.
Would you do in that scenario?
Yeah, I think we're going to have to take a real hard look about where our lean is relative to what we need to fight first.
Sounds like right now, though, you're leaning more towards the inflation side of your mandate.
I think we're seeing and hearing, more importantly in the 10th district, that there is the risk of that is higher than maybe seeing some of the labor numbers come back into line.
So it sounds like you're looking at holding rates steady at the moment as you wait and see. Do you see any room for a rate cut at all, perhaps later this year?
Oh, I think there could be. The data will speak for that environment and that willingness to cut rates. But we have a lot of things in balance right now in the economy, in my opinion. And I'm just trying to be very careful to try to do too much that will create an imbalance.
And where do you see neutral right now?
It's interesting. So I'm a bit of a hybrid Fed president. I'm not an academic relative to the idea of neutral rate. I think it's important to kind of have that discussion about what neutral is. I think it's more of a dynamic. You've got a $30 trillion economy, the 30% of the global economy, and it's a huge, huge stew. And so what you're trying to do is you're trying to make policy decisions that are really keeping things in balance, keeping that very large train on a level track. And so that's the beauty, and I think the healthy friction between some of the labor, full employment and the inflation mandate, and I think that's a healthy thing.
Well, President Schmid, thank you so much for joining me today. So appreciate it. We're really looking forward to the conference.
Thanks for being here. Thank you.
I'm joined now by the president of the Cleveland Federal Reserve, Beth Hammack. Beth, thank you so much for joining me. It's great to see you.
Thanks for having me here. It's great to be here.
It has been exactly 1 year to the day since you took the helm as the president of the Cleveland Federal Reserve. From where we sit, we had a weaker reading on the jobs market. We're not going to get another reading until September 5th. At the same time, we saw inflation bubble up a bit in the month of July. So when you look at both sides of the dual mandate, which side are you more concerned about?
Well, both sides of the dual mandate are under pressure, as you noted right now. We have inflation that's too high and has been trending upwards over the past year. We got one report on the labor market, which is showing some signs of slowing, which is something we need to be attentive to. But the unemployment rate came in at 4.2, which is right around that maximum employment number, and has been really stable around that level between 4% and 4.3 for the past year. So when I look at the balance there, to me, it's important that we maintain a modestly restrictive stance of policy to continue bringing inflation back to target.
On inflation, you and your colleagues have been waiting to see what the impact of tariffs are on inflation. But when we look at the most recent inflation numbers, we saw a little bit of upward pressure on the goods side, but the services side started to pick up. Does that indicate to you that perhaps pressure is building for more widespread inflation in our economy? And given that we saw wholesale prices increase, is that a precursor for prices to be passed on to consumers in the coming months?
So it's something we're watching very closely. I think one of these big debates has been around what is the impact of tariffs going to be, in addition to the other policies that the new administration is bringing in, whether it's fiscal, immigration, or deregulation. And so we're trying to think about that holistically and what those impacts will be. I would say that what we saw in these most recent inflation reports, and again, we try not to make too much out of any one series of reports, we'll get a lot of data before the next meeting, is that you saw that wholesale prices were going up more significantly, but not necessarily being passed on to consumers. That tracks with what I'm hearing when I'm out traveling in the district. And I'm hearing from manufacturers that they're trying to buffer these price pressures as much as they can, but that's not going to last forever. And so some of these price pressures that are coming into the PPI and coming into the wholesale space will eventually make their way into the consumer space.
Building on what you're hearing from contacts in your district, in terms of the impact of tariffs on inflation, we now have some greater clarity on what tariff rates are going to be for certain countries, semiconductors. We have an eye into perhaps some of these exemptions. So how quickly do you think, you said it's not going to last forever, that the fact that companies are buffering consumers, how quickly could we see pass through, and how is that informing your outlook?
Yeah, so when I think about the tariffs and the impact that it can have, it's just now, I think, that we're starting to see some of those impacts play through into the economy. It usually takes 3 to 4 months to start seeing the early impacts of tariffs. And so we're just at that point right now, just past that 3 to 4 month mark. I do expect from the conversations I've had that we're not going to see the full impact of tariff pass-through until sometime next year. There are a lot of prices that only get reset once a year, some contract negotiations that happen around the turn of the year. So it could be that we're still continuing to see some of these impacts in Q1 and Q2. In terms of whether tariffs are going to be a one-time price level impact or more persistently inflationary, certainly the economic theory would say it would be a one-time price level impact, but theory and practice can be quite different. And the way most models think about tariffs is kind of a one and done, a one-time, very clean, we're putting an X% tariff on something and that's it, it's stable. Of course, the way that tariffs have been implemented here, there was a lot of negotiation, a lot of back and forth, and it played out over a much longer time period. And so it may not be that the economic theory really holds in practice.
And so do you suspect we could see more persistent inflation as a result?
I'm certainly attuned to that. My biggest concern is that inflation has been too high for the past 4 years, and right now it's been trending in the wrong direction. And so I think it's really important that we stay modestly restrictive to make sure that we can bring inflation back under control. When I'm out in the district talking to people, I hear constantly about this two-speed economy. I hear about affluent families who are doing really well, really enjoying how the stock market is doing. That's adding to their outlook and how their confidence in the markets. But on lower income families, inflation has been really biting hard. It means that more of their paycheck is being used for food, for housing, and they really don't have money left over to buy new school supplies, to buy new clothing that their kids need as they head back to school.
Turning to the outlook for the jobs market, we did get a weaker payroll number for July. If we were to get another weak reading for the month of August and or see downward revisions to the prior months, putting the 3-month average job growth rate in negative territory, how would you view that in terms of your goals, given where inflation is right now?
Well, I'd have to view that in the context of other indicators that we're looking at. So right now, with the changes that have happened in immigration policy, it's not clear that that headline growth number is going to be as informative as things like the unemployment rate, the vacancies to unemployed ratio, other things that we're looking at on the employment side of the mandate. And that's because we've seen a massive shift. And so, yes, labor demand may be coming down, but labor supply has come down pretty dramatically as well. And so our goal of maintaining employment around maximum needs to look at both sides of that. And it could be that even though we're seeing much slower headline job growth numbers, it could be that the labor market is still in balance. And so we'll need to look at that closely and unpack not just those headline numbers, but the unemployment rate, the vacancies to unemployed ratio, which has been reasonably stable and above 1 at its latest readings. And we also in Cleveland look at things like the WARN notices. So are there massive layoffs that are happening? Are notices happening there? Right now, it's ticked up slightly, but it's not out of historical norms. And so again, when I take the balance of things, there's a lot to be focused on the labor side, but the inflation side is right now giving us a place where we're not at our target. We're at our target on the employment side. We're worried that maybe possibly that could break down, but we know we're missing on the inflation side. And to me, we need to stay laser focused on that to make sure we can bring inflation down.
Before I turn to monetary policy, to your point on the job market, do you think that the unemployment rate is still an accurate indicator given the impact of inflation? Is it just that, given the impact of immigration, is it just that we're seeing a lower break-even rate? How should we unpack that and look at that?
Yeah, I tend to think of the unemployment rate as being one of the more steady indicators that we can look at because it does balance both the supply and the demand. And so if you're looking at the headline growth number, that's really more on the demand side. It doesn't tell you much about the supply. The vacancies to unemployed gives you a little bit of both sides. But I think that unemployment rate is one of our best indicators that we have.
Okay, and then turning to monetary policy, you said in a speech back at the end of June that it may well be the case that policy remains on hold for quite some time before the committee initiates very modest cuts to return policy to a neutral setting. Do you still believe that?
I do still believe that. I think that we have a very small distance to go to get to a neutral set of policy. And I would only want to move into an accommodative stance of policy if I thought that the economy was materially weakening, which I'm not seeing evidence of right now. I'm not seeing any signs of potential significant downturns. And to me, that's what would require us to move into an easy stance of policy rather than our currently modestly restrictive stance. So I don't think we have far to go. I think it can be quite some time.
So that means you see holding rates steady likely come September.
I think that there's a lot of data we're going to get between now and September, and I walk into every meeting with an open mind about what the right thing to do is. But with the data I have right now and with the information I have, if the meeting was tomorrow, I would not see a case for reducing interest rates.
And you said that you see very modest cuts to return to policy. How far are we from neutral at this point? How many cuts away, if you will?
I don't think we're very far. I don't disclose my dot, but I think we're right around. I mean, my longer term rate is towards the higher level. I think the economy's been incredibly resilient. You look at financial conditions and they are broadly supportive of the economy overall. I'm not hearing that interest rates is a huge problem, and that's the thing that's been holding things back. Even if you look at the housing sector, I know people like to talk about the impact rates have on housing, but when I'm out talking to builders or I'm talking to businesses about building new plants, what I hear is that the cost of materials and labor are as impactful and as important, as much of a barrier to beginning new construction projects as interest rates.
Switching gears a bit, President Trump is looking to sort of push Fed Governor Lisa Cook out of the Federal Reserve Board. She's holding her ground. When you look at some of these actions and pressure from the White House on the Fed, how do you view that in the view of Fed independence and setting policy?
So I think of them as completely separate. I think of the way we need to set policy is to serve the American people and to make sure that we're providing an economy that meets our dual mandate of maximum employment and stable prices and offers opportunity and growth for all Americans. I try to tune out the other parts of things that are going on around us, and I would say Fed independence is critically important. There's a large body of research that shows how economies that have independent central banks have better outcomes for their economies, both on the labor and the inflation side. And then finally, on Governor Cook, I would just say that I know her to be an outstanding economist and a person of high integrity, and I know she released a statement yesterday that I would just refer you to look at.
Beth, thank you so much for your insight. I so appreciate it. Hope
Thanks
to speak
for
with you
having
again
me.
soon.
Yeah, absolutely.
Great
Thank
to have
you
you here in Jackson Hole. Jim, thank you so much for joining me on this important day. Fed Chair Jay Powell's last speech here as chair in Jackson Hole. Your reaction to the speech?
I thought it was carefully done. He laid out the case for rate cut in September. I thought he did a good job of talking about both the labor market side and the inflation side, and the judgment of the committee that the policy rate is a little bit too high right now, so they can afford to come down a little, and then that will still put downward pressure on inflation, but it will be a little bit less out of line than where they are right now. And so I think markets are reacting definitely to that, with 2-year going down a lot. And then on the framework, I think it was probably long planned that they would use the Jackson Hole speech to talk about the changes to the framework. I thought that was a good discussion as well, that explained what really seemed like very moderate and logical changes to the framework based on a long discussion that went on for more than a year.
And do you see this as laying the groundwork for a one-time cut of 25 basis points come September and then sort of wait and see and assess? Or is this the kickoff to what could be more of a rate cutting cycle?
Well, in June, the committee said that the median of the committee said that they expected 2 rate cuts by the end of this year. So this would keep the committee on track to have that as an option. They can certainly digest the data as it comes in and decide what they want to do with both the October meeting and the December meeting. But, there's nothing special about the end of the year that can go into next year. I've said that over the next year, it could get as much as 100 basis points of reduction in the policy rate if the data continues to cooperate and inflation comes down slowly toward the 2% target.
Jim, when you and I spoke roughly, a year ago, and I asked you what impact do you think tariffs could have on inflation? And of course, you said, well, it depends how widespread they are, but you were more concerned about the impact on growth than on inflation. Given what we've seen, the challenges to both sides of the Fed's dual mandate, how are you looking at the impact now?
Yeah, I based on the 2018-2019 experience, I think a big change in tariff policy like this does impede economic growth. And the U.S. economy in the first half of the year only grew at a 1.2% pace. So that's slower than potential for the U.S. economy. Something similar happened in 2019. And just like in 2019, the committee is reacting to that by lowering the policy rate here in September. So I think that that's a very understandable reaction of both the global economy and the U.S. economy as all these firms have to decide how they're going to react to the new tariff policy. They might have to move production somewhere else. They might have to decide to change their import or export patterns. That all costs money and interrupts profits. And so all of that is happening. Ultimately, I think the growth rate will return and actually be very strong because it's a growth agenda for this administration. So I think the expectations are still strong, even though the world has to adjust to the new tariff policy.
President Trump has repeatedly criticized the Federal Reserve. He wants to see interest rates slashed to 1%. If you were a member of the Fed now, how would you see the policy path? Obviously, we know 2 cuts penciled in as the median, as you just mentioned moments ago. But given your outlook for growth, that this is a growth agenda, how do you see the policy path? What would you do?
Well, you have to be careful in this business. As you know, you can get a situation where you lower the policy rate, but the longer term rates actually go up because markets start to worry that the Fed isn't going to protect the value of the dollar, that the Fed isn't going to make sure that inflation stays low and stable. And the markets can be very sensitive to that, especially at the long end. And so sometimes when you lower the policy rate too aggressively, you actually get increasing longer term yields. So I do think you have to be careful. You probably have to go slowly. You have to continue to digest the data as it goes in. And that's what leads to the hair splitting world of monetary policy.
So if you were on the committee, how many cuts would you see at this point?
I think they could go, well, they should watch the data. They can go in September here. They can decide what they want to do with the October and the December meeting. And then, like I say, they can continue in 2026. But you could move the schedule up if you felt like the data was coming in that would support that. And otherwise, you could stretch it out a little bit more. There's nothing magical about December 31st, so you can use the fact that the committee meets regularly to compress those a little tighter, move a little faster, or stretch it out a little bit more if the data isn't cooperating as much as you'd like.
We know that you're on the short list to be considered for the next Fed chair. I understand you've spoken with Treasury Secretary Scott Bessent. Have you had any further conversations with the administration on this front, and how far along are they in the interview process from what you can tell?
As I understand it, the interviews are being set up now, and we've certainly been contacted about trying to set those up, but they're not set yet, or at least not for me. They're not set yet, so I think sometime in September, probably after Labor Day. Scheduling's not always the easiest thing, as you know, but we'll get it done, and it's really a good crop of potential people for this role, and so it will, I think it's very impressive, and I'm honored to be part of the group.
And building on that, Treasury Secretary Bessent has said that he's looking to understand the potential candidates' views, not just on monetary policy, but what changes they could make to the central bank. If you were appointed Fed chair, what changes would you make?
Yeah, I think there is quite a bit of groupthink, and it's unfortunate. I think you have a research powerhouse in macroeconomics and monetary economics inside the Fed, and I think you could probably take more advantage of the differing viewpoints and incorporate that into contemporary policy making. I think there's a lot of room for incremental improvement on that, and probably many other aspects of the Fed. I do think when I was in the Fed that the group tries to always be thinking about how can we improve what we do, how can we get better, and I would try to drive that process forward.
And Jim, before I let you go, President Trump really turning up the heat on Fed Governor Lisa Cook. How are you reading the situation?
Yeah, I would like to see due process on this. I don't think you can just charge somebody with something and then all of a sudden, I don't know what. This often occurs inside the Beltway, both parties actually, and I don't really like that. I think you should, if you want to accuse somebody of something, that's fine. The DOJ should, make the charges, bring the case. That would be fine, and then see where you are at that point. But you have to give people a chance to respond, and if you don't have that, it's not consistent with the way we operate in this country.
Jim, I want to thank you so much for your insight today and for joining us on this very important day. So appreciate it. Please come back and talk to us again soon.
Great. Thank you.
Pat, thanks so much for sitting down with me. It's great to see you here back again in Jackson Hole.
Great to be here.
What was your reaction to Fed Chair Powell's speech?
Well, that was a good speech. I think he laid out the options in front of us and not commit to anything. This is important. I know the markets think that he's committed, but I think at this point, there's a lot of uncertainty. I know that word's being used a lot, but the signals are mixed. And I worry right now that we're in a period that, while it's not the 1970s in terms of stagflation, it feels a little stagflation light, a little stagflation-y. So we'll have to watch. I mean, there's some important reports coming out in September before the next meeting, and we'll see how they turn out. But I think that, and also what will come out in September is a new SCP, a new dot plot. And I think you're going to see a lot of divergence of opinions, a lot of diversity in those dots, a lot of spread in where people think things are going to go. And that just reflects the uncertainty that we're facing.
So it sounds like a 25 basis point rate cut may not be a done deal as markets are pricing in right now for September. If we were to get some hotter inflation reports between now and the September meeting, would that take a rate cut off the
Oh
table?
yeah, I think so. I think so. I mean, I had in the last SEP when I was on the committee in June, I had 2 rate cuts for this year. So I think September is definitely on the table. But if we see inflation moving in the wrong direction, and we've seen signs of that, like with the PPI, that was not a good report. And we're hearing other anecdotal stories where the Philly Fed's Manufacturing Business Outlook survey went into negative territory again. There's a lot of mixed signals right now.
And so you mentioned the producer price index, the fact that we saw services inflation really pick up in that report quite a bit. Do you anticipate we could see businesses passing on prices to consumers? Are we still in the early innings of the impact of tariffs? Is that flowing through to services as well?
I think you're going to start to see more pass through to consumers. Businesses were trying to hold back for quite a while, but they were only able to get so much inventory in before they have to start increasing prices.
And so when you looked at Fed Chair Powell's remarks, to me what stood out was that the balance of risks have shifted. Given the fact that we saw that weaker payrolls report, do you think that's what's really swaying Chair Powell and the Fed right now at this point, before we've gotten, as you said, maybe inflation reports more to come here between now and the September meeting?
All right, well, let's be careful on these employment reports. We have to look at what's driving that. We are seeing a reduction, and the chair alluded to this, a reduction in our labor force. A combination of the participation ratio going down and immigration turning negative. And so you cannot expect, when you're seeing a declining labor force, that you're going to get 100,000, 200,000 jobs. The people just aren't there. And you see the other signal, which is the unemployment rate's not really moving substantially up. That tells you something else is going on in the labor market. Now, it's soft and people are cautious. Businesses are holding back some in hiring. But it's not yet in a terrible situation. So I think we can't lean completely to the labor market, that part of the dual mandate. We also have to keep our eye on inflation.
To your point, we are seeing the impact of immigration on the job market, both in terms of labor supply and labor demand, as the Fed chair alluded to. Do you think that the unemployment rate, which has historically been an accurate indicator and one that the Fed has looked at very closely, is still one that we can take signal from, that is still an accurate indicator given the impact of immigration?
Yeah, I do. I mean, but it's one of several. I've never been in the camp of looking at one number, right? That you have to look at the totality of the data you're getting, both private sector estimates plus public sector estimates.
We did not hear from Fed Chair Powell about the balance sheet in the speech. What's your take on what the Fed should be doing? If they're signaling and opening the door for a rate cut, should they also be signaling perhaps a pause there?
Yeah, so the Fed did slow the reduction in the balance sheet on purpose, and we're coming to a place, let's call it neutral, right? And I think we're getting at that point. I actually would be in favor of pausing now the reduction in the balance sheet and just going sideways and letting liabilities build, and that would naturally let that reserves drain off. I think that's a signal that we're going to hold for a little bit and just keep policy slightly restrictive, but not overly restrictive.
Now, we're so focused on 25 basis point increment rate moves and monetary policy, what the Fed is going to do. But what about the fiscal side? Because we know that has implications for the economy, which is going to ripple through and have implications for monetary policy. Are you worried now, given the policies that have been laid out, what the trajectory is for the debt?
So the Fed doesn't talk about fiscal policy, right? It takes it as a given. And I was in that camp 7 weeks ago, right, as a member of the FOMC. Today, I can say I'm very concerned about this. I think the real action in the economy, I trust my colleagues in the FOMC to do the right thing. They're not always going to get it perfectly right, but that's not where the real action in the economy is. The real action in the economy is on the fiscal side, right? In terms of what we're spending, are we stimulating growth? Are we bringing in this talent we need in this country to fuel that growth? Those are the things I'm deeply concerned about.
And to your point, even if the Fed were to cut rates, what happens in the bond market?
Yeah.
Because at what point do the bond vigilantes come out, right, if yields don't come down or even go up?
Right. So you think about what's happening. We're adding more to the deficit, and the estimates are, say, $3.5 trillion over 10 years. In addition to what we're already doing, that means more issuance of treasuries into the market. Why would you expect long rates to come down in that scenario? There's just, unless there's some surge of demand for those treasuries, why would you expect it to come down anytime soon? So I think the bond market is what you should really watch the bond market for signals.
Switching gears a bit, I mean, you just stepped down from the Philly Fed in June, so you're fresh off the Fed. President Trump has exerted a lot of pressure on the central bank to slash rates as low as 1%. Just yesterday now, calling on Fed Governor Lisa Cook to resign. Now they are opening investigations into potential mortgage fraud.
Right.
From where you sit now, how are you looking at this? Does this make you worry about Fed independence and the functioning and what we could see going forward when it comes to the central bank?
Yes, because the independence of the Fed, the independence of any central bank is essential. The central bank does things that people don't like, the old punch bowl, right? And I really worry that that's under threat. Now that said, central banks, the Fed, has to earn that right to be independent each and every day. Now, it's not independent in everything. The Fed still has to answer to Congress, still has to answer to the markets, still has to answer to the American people. But you have to earn that right. And you earn that right by doing your job, right? Doing your job that Congress gave you to do. And I think the Fed's done that. It has to keep doing it. Despite all the noise and all the chaos that seems to be swirling around it, this group will keep their heads on straight and do their job.
You said the Fed has to earn it. Would you want to see any changes to the central bank? That's something that Secretary Besson is looking for with the next Fed chairman.
I mean, it's always worth looking at the possible changes. But I think right now you have to be careful, right? What is fundamentally broken with the Fed? I don't see it. I just simply don't see it. I think the Fed has delivered. It makes mistakes, right? But the markets make mistakes too. So lots of people make mistakes. But it corrects, and it goes back to its mission. And so you got to be careful that you're not going to screw up an institution, a great American institution that does its job every day.
Pat, we'll leave the conversation there. Thank you so much
Thanks.
for your insight. It was great to have you here in Jackson Hole.
Thanks.
Esther, thank you so much for joining me here in Jackson Hole. It's great to see you.
Thank you. It's great to be here again.
That's right. For those who don't know, you're the former head of the Kansas City Federal Reserve, so you have done this in the past for over a decade before current President Schmid. You heard Chair Powell this morning. What was your reaction to his speech?
Well, the chairman always does a good job, I think, in putting together a well-articulated message. And this one had two parts to it. One was to talk about the outlook for the economy, and he snuck in monetary policy there, as well as talking about this framework review, which is a big deal. So the speech was really, I think, so highly anticipated. And as you know, the markets had already priced in rate cuts. And so I think the big anticipation was, would he affirm that? Would he sort of push against that? And my reaction was, he opened the door. He stopped short of saying, yes, that's coming. But he did talk about how the balance of risk was shifting and that could warrant an adjustment in their policy.
Were you surprised at all? Because in past conversations that you and I have had, you've been a bit more concerned about the inflation side of the mandate. Do you think the Fed has flexibility there if we were to get some hotter inflation reports between now and the next policy meeting?
So I think these next reports are going to be very important, both on the labor side and thinking about inflation, because they will either have to affirm this message of which risk is greater here, that the labor market will weaken more or that we have an inflation issue that is persisting. My own concern, and we heard this in the chairman's speech, the condition that's required for maximum employment is price stability. And so I lean personally more heavily to saying I would want to see a very clear disinflationary path. and we have not seen that yet. And so I think these next reports could be very telling in terms of how that committee turns.
If we were to see inflation remain around this 3% level, the job market where it is right now, and the Fed were to cut, would you be concerned that that would set the pathway to reignite inflation?
I would be concerned about that. And I think even today, as we see the market reaction, we already were experiencing pretty easy financial conditions. Today, you saw some accelerant to that. So I think you have to be very mindful that easing financial conditions into a time when you have inflation this far off target is a risk in and of itself. That was acknowledged in the speech today. For me personally, it'd be the thing I'd really have my eyes on.
If you had to get your crystal ball out, what does the path for policy potentially look like this fall? If they did cut in September, would it be one and wait and see? We know there's two cuts that have been penciled in. We know that we're going to get changes to that in September as well.
Yeah, I think typically when the Fed makes a move, they're going to make another move and not be in a wait and see mode. So I think it would be reasonable to think when the first resumption of cutting happens that you're likely to see more. Again, I'd be very cautious about that at this time. Again, given inflation, and I think we heard the message today, tariffs are already beginning to show through here. Now, not a one-time hit, could be spread out. But inflation expectations are a funny thing. They're anchored until they're not. And so that's a part of the framework that I really appreciated that being emphasized. I think they have to keep a careful eye on those inflation expectations.
On the monetary policy framework, we saw them drop the average inflation targeting strategy, now adopting the long-term target of 2%. And you were a member of the Fed when this was first adopted back in 2012. We're seeing a lot of the language sort of revert back to that original form. What are your thoughts overall on the changes that were proposed?
So I'm pleased to see the changes, and I'm glad to see it look more like the 2012 document, which of course was trying to be a broad statement about the committee's priorities and how it would judge, how it would approach its dual mandate. The 2020 version of that framework review introduced something that I think at the time felt like there had been a structural shift in the economy. And I think what we learned with the recent inflation episode was that framework could best serve the FOMC when it is broader and anticipates a broader set of conditions.
Switching gears, President Trump escalating the threat to oust Fed Governor Lisa Cook. Curious how you view that and the implications for Federal Reserve independence.
So we've seen this pressure for some time now coming onto the Fed in various forms, persistent for sure. And I think for the Federal Reserve, this will be a real test of its ability to carry out what is its most important function, and that is delivering on its congressional mandates on behalf of the American public. Its design was intended to withstand these kinds of pressures. And so we'll have to see. I'm confident that the committee has their focus on the right issues as they're here, and these other issues will have to be resolved with further review.
Before I let you go, do these continued attacks and threats damage potentially the public's perception of the Federal Reserve and their ability to carry out what they need to do in terms of monetary policy?
Well, it's a very good question, Jennifer, because trust is essential for an institution like the Fed that is dealing with money and how it affects the lives of every American. So when trust is undermined, whether it is through outside forces, whether it is through policy mistakes that happen, you have to worry about that, and you have to make sure that the public understands that the institution is working on its behalf.
We'll have to leave the conversation there, but Esther, thank you so much, as always, for your insights. So appreciate it.
Good to see you. Thank you.